St. Louis. I just pulled some properties for client and for Gwinnett County. There's 590 properties for sale in Gwinnett County for from $400 to $600,000.
Yeah.
Dude, that's got to be more than any. I mean, that's like what the numbers are for the state of Georgia. I mean, it's crazy the amount of properties over there for sale. Anyway, Kline will come in. What's going on, Kline? You'll be unmuted in a second.
You see me?
Yep, there you are, and we can hear you.
Okay, good.
We lost 2 people, but anyway.
They heard I was coming.
Yeah, they got scared. So, guys, Kline has been our CPA for a while. I don't know how long it's been. I've actually never met him. I think the first time I called him was a few days ago to talk about doing this. Brandy handles all that with him, goes through email and stuff. But Kline, put your information in the chat and then say it for everybody now, and then we'll do it again at the end of the call, and that way they can have it, because they won't have access to the chat information after they get the recording. So, but he's going to share with us, well, different things, but right now I want to focus on why to set up an LLC, how to pay yourself through an LLC, and really how simple it is to do it, and how it makes you and positions you a little bit different in the eyes of the IRS.
So I'm typing this information in 1 second here.
Have y'all ever seen that meme that says, I don't know if I sent it out to y'all or not, it says theirs, and it's the IRS, but it separates, so it says theirs. Anyway.
All right.
All right, hit it.
So I have it in there. So basically, the concept of what we do as CPA is very simple. We're trying to help our clients pay the least amount of taxes that you can pay legally, period. There's things that, when you have a problem or you're trying to strategically plan for taxes or anything, if you call the IRS, they never give you any help. They're not ever going to say, hey, here's the way to do that. They just don't do that, partly because they're dumb and they don't know. And the other part is because they don't care. So for people sometimes that for different reasons get in over their head and they owe 50,000, 100,000, 500,000 in taxes, you can't call the IRS and say, hey, help me with this problem. They basically just say, man, it's too bad, you're bad. They're not really helpful. So you need a professional that's going to guide you through the basic setup of what you want to do and what you don't want to do. And some of you may be doing the right thing, some of you may be not. The number one thing I tell every small business is never, 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 ever, ever, ever file on a Schedule C, period. Never. Very few times in life do you say never. That's an absolute never. Never file on the Schedule C. There's 2 major reasons you don't want to file on the Schedule C. One, it's the most audited form of every form in the IRS combined. If they take every other form, every business form, every mega business that they audit, the Schedule C gets audited more than all the rest of them added together, period. There's a reason. IRS, even though it's a bureaucracy, they have limited manpower. They're not going to take that limited manpower, as inefficient and as horrible as they are, they're not going to take that manpower in audit forms that do not generate revenue. So as a bureaucracy, you get attaboys. We audited that terrible Kline Driver and we got $40,000, attaboy, as well as saying, well, we audited Kline and we didn't get anything. So the Schedule C is rampant with fraud, just rampant, rampant, rampant. It's on the 1040, it's in the TurboTax software, it's in the free software. And what has happened over the years is that people will maybe be some sort of sales manager or something. They get a W-2 for 250,000, 500,000, and they're paying lots of taxes. And they find some unscrupulous tax preparer, not necessarily a CPA, that says, oh, I can get your refund. And what they do is they make up fraudulent businesses and fraudulent losses and put it on the tax return. And they go back to that person with the big W-2. See, I got you a big refund. Well, what the IRS generally does is they wait about 3 years and they come back and they audit that person, and they audit them for 3 years. And now all of a sudden that person owes $100,000, $150,000. and the person that prepared the tax return is nowhere to be found. And this is just something that happens over and over and over. So that's where the IRS puts their manpower. So you don't want to be on a Schedule C. So if you've done a Schedule C in the past, you want to get off the Schedule C train. The second reason you want to get off the Schedule C is the Schedule C forces you to pay taxes you don't have to legally pay. All the profit on the Schedule C, 100% of it is going to be subject to Social Security tax and Medicare tax. So the way it works is, I'm not going to go into the formula because the IRS is stupid, but self-employment tax generally is 15.3%. On self-employed people on the Schedule C, somehow miraculously it comes down to 14.129. What does that mean? If you end up with $10,000 worth of profit on a Schedule C for your real estate business, Social Security tax, Medicare tax on top of income taxes is $1,413 basically. If you made $100,000 profit, you pay an additional $14,129 additional money, real money on top, and that's not income taxes. It's not federal income tax. That's not Georgia income tax. That's Social Security tax and Medicare tax. So what's the alternative? The alternative is that you need an LLC and you need an S election on that LLC. At that point, you are filing 2 tax returns. And so, yes, of course, whoever prepares your taxes, you're probably not going to want to do the S election requires you use the form 1120S. You probably will not want to do it yourself. But again, if you just save Social Security Medicare tax on $10,000 of profit, you save $1,413 in real money, not a credit, not some phantom savings. It's a real savings. So that's the big thing that we try to make sure. We'll do over 350 small business returns this year, and we don't do a single one on the Schedule C. And again, it's because we don't want our clients to get audited. If they get audited, guess who has to deal with it? Me. I've done audits in the past. We used to advertise for them. I've never had one of my clients audited, and it's not because we're timid. It's because you use the right form. You dot your I's, you cross your T's, use the correct forms. The IRS may be dumb, but they're not plumb dumb. They have certain audit programs that are common sense. They have a 00 audit program. So a lot of times in our business, we have some small business guy, maybe he's a painter, maybe he's a landscaping person, and he did not get into self-employed business. He didn't wake up one day and goes, my gosh, I love paperwork. I want to be self-employed. Never been so. So the guy goes out and pushes the lawnmower all day or runs the paint sprayer all day. He doesn't come home and go, man, I can't wait till I get back to my desk. So what has happened? It comes around tax time. He's got that gnawing negative feeling in the back of his head. I got to get my books together. I don't know where are my receipts. And so what happens a lot of times, that guy knows what he pays his mortgage. He knows what his car payments are. He knows what his insurance payments are. And he's sitting there going, I probably make about $5,000 a month because that's what it takes to pay my bills. And so he'll put together a tax return where he's made $5,000 a month that he's going to pay taxes on. But the problem is, what's your fuel expense? $2,000. What's your advertising? $3,000. What's your cell phone? $1,200. Well, the IRS has a 00 audit program. So these people put down the things, and they might be within $2,000 or $3,000 what they actually made. They just don't know where all the receipts are. They kind of know where they live and what they spend and those kind of things. So the IRS has keystroke software. There's a thing called I think it's the I want to say Bernoulli, but that's not it. The Bender effect. So when you go to a grocery store, 1 is the most repetitive number when you buy things because everything starts at 0 and then it has a cents and it goes up to $1. And then when you get to $1, it goes to $10. And then you have 11, 12, 13, 14. So they can predict through random number theory of what your expenses should look like when you type it on a tax return. It's just statistics. So when people are making up numbers and they're going 232, 454, 676, computers are going to catch you. So that's the thing that you've got to, do certain things to make sure that you're putting things over. You want to make money, you don't want to do paperwork. You have to do paperwork. You want to make money, you don't want to do taxes, but you have to do the taxes. So as a small business person, you have to, either take that on yourself. And when I'm not trying to sell my business to anybody, so specifically what I'm really talking about is bookkeeping, and we don't do internal bookkeeping at our firm. We have people that we work with, we farm that out to. But you or somebody has to, take your bank statements and your debit card statements, your credit card statements monthly, and you got to record those expenses. And you want to probably do it in real time, because if here we are in June of 2022, and if you haven't done any book work, you go back to January 1 of 2022, you're going to see a charge on your debit card or your credit card that says XYZ LLC, $38.16. And you're going to be sitting there looking at your own statement going, man, what was that? Well, that just happened to be the LLC that owns the gas station, that's a Citgo station that you bought gas at, but you can't remember because it's been so long. If you move that forward, which a lot of small business people do, they go through all of 2022 and then they file an extension, and then they get into the summer of 2023, they really can't remember. And the one thing I tell all small businesses, because you didn't decide to be a realtor because you love paperwork, the number one things that small businesses miss when it comes to taxes is their deductions. Because that, again, that's none of you run home at night after you run out and, listed houses, shown houses, done closing. You don't get all giddy going home, man, I can't wait to get to my desk. That's just not reality. But, the thing is, you have to do it in stages. When you're young and you buy your first house and you don't have a lot of money and you got a yard, you go down to Home Depot or Lowe's, you spend $100 on your lawnmower and you cut your own grass. Maybe a few years down the road, you get a few promotions, you start your own business, you make a little bit more money, you pay somebody else to mow your grass. So you have to kind of figure out where you are in your career with those kind of things. As far as bookkeepers, they're really not that expensive. And I would highly suggest that you consider that. The bookkeepers that we use charge about $25 an hour. You could have them do your books every quarter and probably wouldn't charge you more than $50 every quarter, maybe $75. You take your bank statements, you take your credit card statements and go through them and pull the things out and make you a real profit and loss statement. So even if you're going to do your own tax return, if you have somebody do your books, then when you get past December and have that bookkeeper provide you a profit and loss statement, then it's going to be much easier for you to take that information and put it on your tax return. And if you ever get audited, God forbid, at least you'll have real numbers that you have, that you would be able to provide. But again, our firm is there to be a tax consultant, not a tax historian. What I mean by that, if somebody walks in their office in February or March and say, hey, here's my stuff, do me a tax return, save me some money. Well, at that point, I'm just a tax historian. I'm just reporting what's already transpired. What we want to be is a tax consultant. So at the point in time, you're going to get a new car, fine, should I lease the car? Should I purchase the car? You're going to get a rental property. You're going to settle rental property. You're going to invest into some sort of business assets. You sold a rental house you've had for 20 years. What do I want to do? Do I do a like-kind exchange? How can I push the tax bill down the road? That's what CPAs are there for. And even though we tell people this all the time, I can't tell you how many times year in and year out people came in. I sold a rental property. I have, $150,000 gain. I sure hope I don't owe any taxes. And you're like, you're going to owe taxes. If they came to me before December 31st, I could have given them ideas to either get out of the tax period, defer it for years and years and years, or at least kick the can down the road legally for 2 to 3 years. And if you end up having to owe because you sold a rental property and you're going to have to pay $25,000 in taxes on that, wouldn't you like to be able to kick that can down the road a year or two? Of course you could. And that's really what a good CPA is going to do, is to that when you have those kind of questions, you just call and ask, whether it's payroll for yourself, for some people that work for you. Should I do 1099? Should I do W-2? Should I do a 401k, IRA, Roth, all those kind of things? That's what you want the CPA for. ultimately, every one of you there are trying to make money. When you get to the point that you make enough money that you got all of your bills and things paid, then you're trying to put away money for the future. Well, it's really comes down to that point of how much of that money can you hold on to. So if you can legally avoid taxes or legally defer taxes, then that's what you're going to want to do. You know, penny saved is penny earned. Well, in taxes, it's thousands of dollars saved is thousands of dollars. So, and a lot of the things that you hear by well-meaning people, or where you hear it on TV or YouTube channels or stuff like that, they may mean well, but not as everybody's as smart as they think they are. And I'm not necessarily saying that I'm the smartest guy in the world. My wife will tell you I'm not. You know, there's things that you learn. You know, I've been doing this gig for 30 years, and there's things that you learn. You know, like I said, I used to do audits. I mean, I know exactly what an IRS agent is going to do if they audit you. The very first thing they're going to do is say, Daniel, give me all your bank statements. And Daniel's going to the bank statements, and they're going to take all of Daniel's deposits, every check from grandma, every PPP loan, and they're going to say, Daniel, you made $500,000 last year. And Daniel's going to say, whoa, buddy, I didn't make that much money. That's what your deposits say. Well, then you have to back out the stuff that's a loan, the money that got transferred from account A to account B. So there's certain things that we know that they're going to do.
Then they're going to say, now you have to submit for 2010 since you got audited for 2009. That's exactly what they did.
Well, a good CPA is going to destroy them because these people are incredibly, incredibly, incredibly dumb.
But it was scary. They had pictures of inside of my house, and they had done evaluations on my paintings. It was scary.
How did they get in your house? We don't ever let them.
They took pictures through the windows.
Well, that's actually a crime.
And then they wanted to meet me right outside my house. I think it was like a Starbucks or something at the time. And I'm like, man, you driving all the way up here? He says, oh yeah, I've been there before. I was there when I came out to look at your house. I was like, you were here at my house? It was weird. It was very weird going through metal detectors and stuff. Good thing is I didn't have to pay them any money.
Well, nobody wants to go through an audit to begin with, even if you're going to come out not owing the money, just for the same reason that, you know, the anxiety that goes with it.
Stress.
A good representative will tell them to kick rocks and write up their BS report, and we'll see you in appeals. Bye. So, I mean, I've done audits before where the audit examiners are so rude and so ignorant, and they almost play like a cop. So I had a situation one time where the guy owned like a nursing hospice care type business where he hired ladies and guys and sent them out, and his wife was actually a physician. And so we had an appointment at their office to meet with the IRS lady. Well, the wife was running her rounds and she was a few minutes late. And you put down certain things that they're trying to figure out. So the guy answered all his questions. They do an interview to start, you know, how long you been married, where do you live, how long you live there, how much do you make, blah, blah, blah. So then he's trying to ask stuff about the, you know, the wife, the spouse, if she wasn't there yet. And so I'm sitting there and I'm listening. I haven't really said too much. And then the guy's the nicest guy in the world. And she goes, well, can I ask you some questions about your wife? And what is he going to say? No. He says, I guess so. And then so he starts asking things. Well, how far is it from your house to the hospital? And the guy's like, 15 miles. Well, the problem is when you give them those answers and it turns out that it's 12 miles, they say you lied to him. And so I said, well, he's not going to answer those questions. And so she says, well, he said he would. I said, well, I'm the representative and I'm telling you, he's not going to answer the questions. You're going to wait for the lady to get there. And she got all snarky and said, well, you know, you give me a hard time, I'll make you come to my office. Well, I just jumped up and got in her drill. I said, let me tell you something, heifer. You ain't have no subpoena power. You're not making me do a damn thing. I'll help you pack your shit and put it in your car. You can write your bullshit report and we'll just appeal it, or you can just sit and wait till the lady gets there. And the guy gets kind of, you know, he's out there, oh my God, I can't believe, oh my God, calm down. And I'm like, listen, lady, you don't have that kind of power. But the average person doesn't know that.
Yeah, nobody knows what kind of power they have because all we do is preach about the IRS and the fear, the boogie monster. of the IRS.
Well, it is, and the thing is, there a lot. This same person is going through. They got audited for 3 years, and she's going through it. And this guy had been in home construction, and he had actually filed a bankruptcy. So we had two different issues. One was a forgiveness of debt, which is the 1099-C, and it was on the tax return on the forgiveness of debt form, which is 982. And she's like, "Oh, the forgiveness of debt is not on the tax return." Which what she was really saying is you didn't add that charge off to his income, which you don't have to if you use that form. And I go, "It's on there." And she goes, "No, it's not." I go, "Man, it's on there." She goes, "No, it's not." I go, "It's on form 982. She goes, "Oh, I've never heard of that form before." I go, "Man, that's going to be a long audit." These are the people you want to avoid. They'll sit there and look at your Ford truck and tell you it's a Lamborghini. And you're like, "No, it says Ford." Now, I'm pretty sure it's Lamborghini, and you end up in appeals anyway. So that's another reason why, if you've been filing on Schedule C, you don't want to be on that form, because if you stay on a Schedule C, you're going to go see that person. And they're supposed to, and this is another thing that there's in their guidelines, if they audit somebody, they're supposed to say, "Hey, I want to see your travel expenses. I want to see your office rent." They're supposed to have something specific that they want to see. There's some anomaly, something statistical. They're not supposed to just say, "Oh, hey, Daniel, you made a bunch of money. We're going to audit you." So again, these are the things that the average person doesn't have. I had an auditor one time send a letter to a client and said, "Just bring everything that you did to prepare your tax return, everything, every receipt, every number, bring it all." And I'm like, "No, we're not bringing anything, nothing, zero." I said, "You need to ask something specific you want to audit. You're not going to just go on a fishing expedition." But I could write books. I shouldn't even complain about it. It's like, somebody smarter than me says, if you don't like blood, don't be a surgeon. So as a CPA, you can't stand the IRS and maybe change professions. But we do have a lot of wasted time in our practice by just complete incompetence of the IRS. And you have to help your client when they get these dear dumb letters. So
I want to ask you
anything you want to go into?
Yeah, well, I want to ask you, we only have like 5 more minutes on these calls. I try to keep them to half hour, but can you show us or tell us how capital gains are calculated in a few minutes? Is that possible or no?
Well, yes, I can tell you capital gains are calculated, but I mean, essentially it's 15 or 20% based on the gain. But let's talk about something specific. Let's say you sold a rental house. And this is where sometimes it gets confusing. The house is worth, you paid $130,000 for it. Let's say that the depreciation is 27.5 years. So let's say you had it for 30 years. You paid $130,000 for it. Then what happens is that, and this was a real story. I had a client that bought some condos in Ohio in the 80s, and it didn't have very good management. So he paid a total of about $72,000 for the two condos, and roughly 40 years later, he sold them both together combined for $35,000. So he actually had a loss, as far as you say, well, he paid 70, but he sold it for 35. But the properties were fully depreciated. So what happens is when you sell a rental property, you have to add back the depreciation. In other words, you wouldn't have any basis. So if you, in this particular situation where I was giving an example, you pay like $130,000, you're going to allocate some of that amount to the underlying land. Now in a condo, you don't do that, but in a townhome or a single family detached house, there's a lot value. So typically what you would do is say the lot's worth 30, the house structure on top was worth 100 when you bought it. So you've been taking depreciation, and if you've had it more than 27.5 years, it's 100% depreciated. So even in his case, where from the underlying asset under there, he had to add back roughly $53,000 in depreciation. So he had a $70,000 purchase price and a $35,000 sales. Oh, you get a $35,000 loss. Well, you have to add back that depreciation. The depreciation add back is ordinary income, tax at ordinary tax rates. If you buy rental property and it increases in value, the difference between the original purchase price and the sale price, that's all capital gains. But that depreciation add back is ordinary income.
That's called cost basis, right?
Yeah, it's cost basis.
Because I just did that. I helped a lady buy something for about $350, just sold it for $475 or something 4 years later. And the first time I'd ever seen it, I don't know if this is a new rule or not, but it's called alien. I can't remember. It's alien something, and it means that she lives outside of the border of Georgia. She lives in California, and they were going to withhold 3% of her proceeds
4%.
as what?
4%.
It's 4% of her proceeds
Yep.
for, and so that she would pay taxes in Georgia, basically.
Yes.
And then I had to go through a whole with this attorney, a whole cost basis for that. And I think that's the first time I've ever done that. But maybe it's because she made so much money. I don't know. But anyway,
Yeah, that's a common practice. So basically every state, the funny thing is they consider foreign and domestic. So for all of us, we think if you're American, you're domestic, and if you're not American, you're foreign, right? But the states don't look at it that way. The states look at it, if you're Georgian, you're domestic, and if you ain't Georgian, you're foreign.
right.
And that's the way they do their taxes. So anybody that, if you have an LLC and you live out of the state, if you sell property and you live out of the state, they have the 4% withholding. That what it really does, it's there for, every state does it. It forces you to file a Georgia income tax return so the state of Georgia can get their tax. Otherwise, what would happen is that person in California would sell that house in Georgia and they would not file a Georgia income tax return. They would just file it on their California state income tax return.
Is it different? Is it different if it's a corporate entity versus a single person? Is it 3%, 4%, 5%? Are there differences of the entity?
To be honest with you, it's been a really, really, really long time since I've done a C Corp. Now, if it's an S Corp, it's exactly the same because it's a flow through. But typically it's really based on how the property is titled. If Joe Smith.
This was in her personal name.
Yeah, it would always be individual. For most people that we do that for liability reasons and stuff anyway, we tell them to set up an LLC and quit claiming that property into the LLC. Like your rent under the LLC, set your leases up under the LLC, do your insurance in the LLC, deposit your money in the LLC. And what it does is it gives you legal protection. If somebody has a slip and fall, the house burns down, and God forbid a child gets killed or something like that, you want to be protected. And you have to set up that LLC, and you have to do everything as an LLC. So there's a lot of crooked attorneys, smart attorneys, whatever you want to do it. So even if you set up the LLC, but they write the check to Daniel Klotfelter, it doesn't work. So you have to do everything in the LLC. In that scenario, they're still going to do the 4% withholding. And again, what they're doing is they're forcing the filing of that Georgia income tax return. But that's completely separate of the basis. If whether you live in Georgia or you don't live in Georgia, the basis and the cost and figuring out the profit and the capital gains and the ordinary income is exactly the same computation. All the 4% does is that if you sell a house for $400,000 to make the math easy, they're going to take $16,000 and send it to the state of Georgia. You got to file a tax return to prove that you don't owe $16,000.
Yeah, to get your money back.
You get your money back. That's all that is.
Yeah.
So it may be a thing that she didn't really owe anything because she bought it for $400 and sold it for $420 and had $7,000 in closing costs, and the tax is negligible, but they've got $16,000.
Right. Her actually came out to be like $3,700 or something like that. Is what the real number was, because she made like a couple $100,000. So on a personal residence, of course, as a single person, non-married person, you have a $250,000 exclusion on gain if you've lived in it 2 of the last 5 years. For a married couple, it's a $500,000 exclusion of the gain if you lived in it 2 of the last 5 years. So you bought a house in 2017, you lived in it 2017, 2018. You got transferred in 2019, 2020, 2021. You lived in another state, you lived in another town, but you didn't rent that property out. You can still sell that house that you bought in 2017 as a primary residence and avoid the gain. $250 single, $500 as a married filing joint.
for any increase. Again, if you rent it out, you know, you can still get the exclusion, but you got to add back that depreciation, and it's always ordinary income. So it's a little bit confusing, but basically, if you buy something for $100,000 and you sell it for 110, you understand it's $10,000 profit, right? But if you buy something for $100,000 and you depreciate the $100,000, meaning you've already written it off, then technically you have zero basis because it's already been written off in depreciation. That's why you have to add back the depreciation to get your basis back. The sad thing, and so when you take depreciation as an expense, it reduces ordinary income. So when you have to add depreciation back when you sell it, it's also treated as ordinary income. In the situation where the guy sold the condo as a loss, his capital gain was able to actually to offset some of that ordinary income add back.
What do people do with like heavy equipment and stuff? How does that work out? Like say you buy a $200,000 piece of equipment because you have on a paving company.
Well, that's a discussion for a different day. That's
Okay.
a way to help people avoid taxes. But the long story short is, what we have a lot of people do that are getting big gains is that, let's say that you sell a property and you just make $200,000 and it's a rental property. So what's happening is that somebody's going to go out and buy a $200,000 bulldozer, put $10,000 down, take a note, and they're going to get a $200,000 write-off under Section 179 write-off. So we have a lot of people that at the end of the year, not a lot, but we have several of our businesses that are fairly profitable. At the end of the year, they go on a buying spree for equipment because they can get over $1 million write-off against their ordinary business income to bring their taxes down to nothing. And then if, these are people that are in business that deal in equipment, they're not just buying something to buy it.
Right.
So they know how to go to an auction, whatever. They go out and buy a skid steer, a track hoe, excavator, something like that at an auction, and they spend, $50,000, $100,000, whatever, but they know if they really need cash, they can turn around in January and sell it for more money than they pay for it because they know what they're doing. So what they did is they bought it in December. So that's going to be used for the whole year to reduce the taxes for that current year. And then when they sell it in the next year, then that's not going to help. They're not going to have to deal with that until April 15th of the following year. So they can kick the can down the road. Sometimes they buy equipment because they need it. And sometimes they, buy the equipment because they just want to kick the can down the road. And
I notice right now that a lot of people that have money are buying heavy equipment and renting. So they rent it to these outfits, their landscape crews and stuff like that. So they rent it by the hour, a dozer or whatever. So they've actually turned it into a little micro business on top of their other business.
They can. I mean, look, you absolutely can do that. I mean, there's a lot of people that are taking their cash and they're
pulling it out of the market and they're doing this kind of stuff.
Well, I mean, if you don't need the tax write-off, it's not really that big of a deal. So let's just say you've got $500,000 in the market and you don't owe a bunch of taxes. It's not nearly as attractive. So can you pull it out and make sure that you don't lose your money in the market? The market could go down, of course. So if you pull the $500,000 out, you don't take that loss. But just to reinvest it at that point in time, you want to, be able to you want to get the double hit. You want to reduce your tax bill and you want to make money. So there's a lot of people that are taking their cash and they're buying, going into, not necessarily the legal term, but they're doing a joint venture with other people. They're buying MRIs, they're buying CAT scan machines, they're setting up dialysis labs, they're doing these things because they can get 100% write-off. What do they call it? Open MRI machine, brand new, and those things run, $2, $3, $4 million. And most people aren't going to put that kind of cash, but they'll get 10 guys put in 300,000 or something like that, and they'll go buy one. And those things, they just print money because the insurance companies, pay good money for those things. Every time you upgrade anything, whether it's a car or anything, it's got more technology. The reason they keep upgrading the MRIs, the reason that 5-year-old machine, even though it looks perfect and it works, whatever, it doesn't have the same clarity, doesn't have the same filters, the same scans, it doesn't do as much stuff. So there's always, now that's why you see the billboards around town, MRI $400. Well, once it's 5 years old, it doesn't tell you near as much as the brand new ones do. And the insurance companies are still paying big bucks for they're not paying $400 for the newsstand stuff. But again, you always have, when it comes to money, you have competing goals, and one goal may oppose the other goal. So you have to weigh it. So if you all come to me and say, hey, I don't want to pay any taxes, period. Well, one answer is make no money, right? Another answer is be a bad business person, lose money. Those aren't necessarily good answers. So, you always have certain things. How do I save money? And, so in that vein, you don't want to spend $1 to save a quarter. And that's where sometimes it comes into buying equipment and those kind of things. If you can offset a big tax bill and buy some type of equipment that's 100% write-off, avoid a tax bill, and you can turn it into making cash, it's good. But what you don't want to do necessarily is get a $100,000 write-off and then get a $100,000 add back. You haven't necessarily, made that much money. And what you're trying to do is set up a stream of income as a general rule versus kind of like you're talking about renting the equipment out. If you're buying construction equipment and those kind of things, you got to be set up with somebody that's really good to management, because those things get tore up. What people do to rental cars. Well, when you get into track hose and skid steers and stuff like that, multiply that times 100, because these idiots drive off cliffs. They just tear things up. It's horrible. You hope that if there's a rental car, they don't wreck it. When you send out, a construction equipment, you just hope they don't wreck it too badly. So, but there's a lot of good ideas out there, and there's so much information out there. It's obviously, everybody knows it's hard to digest. You've got YouTube, you've got Google, you've got so much information out there. The main thing is you have to learn the tax strategy. Once you learn the tax strategy, and not that it's a secret strategy, just how the tax code works, the general parts of the tax code, then you can come up with your own thing. Because the number one thing I advise people when it comes to getting, the construction equipment that you're renting out, you should, in my opinion, and it's just my opinion, you should only do it in things that you have interest and knowledge of. Otherwise, you're kind of gambling. I've got a client right now that buys these $300,000 cars, and they rent them down in South Beach and Miami and stuff like that. And so far, she's done really well. And she called me and asked me about it, and I'm like, I'm not sure. And it's not just because I'm a CPA and conservative, but she's signing a note for a $300,000 car, and she did. And she turned it over to this rental car, and it's actually worked out pretty well.
Yeah, but they rent for like $800 a day.
Oh yeah, it's crazy. But you're sitting there thinking her payment, if I remember correctly, is like $2,800 a month or something. I don't know. It's high. And I'm sitting there thinking, what are you going to do if you don't rent it? What are you going to do if it gets tore up and it can't get rented because it's getting repaired? There's a lot of big ifs in there. And when you get into the big numbers, obviously, you understand how are you guys froze? Can you hear me?
Yeah, we're here.
All right, everybody's frozen my screen. But anyway, obviously, it's like somebody having 10 rental properties and every payment's, $1,000 a month. And so I'm just making round numbers. So your mortgage payment in rental properties is $10,000. What happens if something happens and you've got unrented houses and you're not collecting $10,000? Do you have enough of your own cash flow to cover those mortgage payments, so you're not screwing the credit up? But there's a lot of different things that are out there. The company that set up those cars, they're doing 100% write-off on those cars. They can do up to, I think it's $1.5 million this year. But if it was, a business car, you can't write that much off. The maximum write-off, I think, is $18,000 a year. So if you buy a $300,000 car, even if you finance it at $18,000 write-off, isn't a very good write-off.
Yeah, there's a debt service for sure. Does anybody have any questions for him or something that we can think about for next week? No?
Answer them all.
You answered it all, man. I'll tell you what. A CPA that tells jokes.
No, head's still spinning just from all the information.
Well, it's that way for every client. Client will call and ask us some information. By the time we get done, we have to apologize and say, well, I know you were asking for a sip of water and I just fed you with a fire hose. There's a lot of repetition in what we do with our clients because it's just not something you do every day. I could not teach you how to rebuild a transmission in one day, and you couldn't teach me. So it's just foreign information. So you have to take what you can, process it, formulate questions, come back and have somebody kind of tell you the same thing over 2 or 3 times. That's generally what it takes to get this stuff. In my partnership class, when I was in grad school, I was a good student. I read the book, I read the chapter. I did not understand it. I read it so many times, I had almost memorized the first 2 chapters. And I went to my professor and I'm like, I don't understand this. And he goes, what do you don't understand? Well, then I started repeating what was in the chapter. He goes, no, you get it. And I go, no, I don't. I'm just repeating it. So sometimes it just takes a while to soak things in. So I don't mind. You've got my phone number in the comment section in the chat box. We're always busy, but we'll answer questions if you call.
Yeah, my goal is to give our organization and others access. That's my whole goal, is to give other people access to a team of people around them. Like obviously you're in my team and they could have access to it. It's 404-219-4002 is his cell phone number. I believe he's in Johns Creek. But I just want to give people access and give them a little bit to think about, and then come back again, 30 minutes, think about it, some more things, and hit a few other topics. And as they go through the week, they'll come up with things. They'll call me and ask me, and then I'll ask you next week. That's kind of the way we run our little group here. But anyway, Kline Driver, I appreciate it, man. And if anybody has questions, get them to me and let's hit them up with it.
Let me add one thing, Daniel.
Okay.
I was trying to type at the same time we started. I put 4675 Johns Creek Parkway. There is a 4675 Johns Creek Parkway. That's not me. And my computer's froze, so I can't fix it or can't add to the chat. We're actually 4675 East Johns Crossing.
Okay.
So I'll send that to you. So I just couldn't figure things out.
The main thing is his cell phone number,
Yep.
404-219-4002.
Yeah, that's it.
All right, guys. Thank you so much. I'm going to hang out for a minute. You guys got questions for me, hit me with them. I'm going to stop recording. See you, Kline. Thank you.